Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Inc., a registered broker-dealer, member FINRA. Fixed insurance is offered through various independent insurance companies. Cambridge does not offer tax or legal advice.
Welcome to the SA Update. I'm your host, Mike Schuster. Each episode, we dive into meaningful conversations and timely topics designed to empower our communities and clients. From financial insights to real-life confidence, we're here to help you stay informed, inspired, and ready for what's next. Welcome back to the podcast. I'm Mike Schuster, your host. Today, our guest is Maria Katsileros, who is a client portfolio manager at Aristotle, Boston, and a member of the investment team there. Maria has actually her portfolio that she runs. Many of our clients are in that. Interesting background about Maria is she earned her Bachelor of Science degree in psychology and has her Bachelor of Arts degree in modern Greek language and literature from Boston University. She also holds her certified investment management consultant designation and is a chartered CSRA counselor also. Maria, welcome to the podcast. And you're the first guest I've had that has a psychology background that does portfolio management. So this is going to be an interesting podcast today.
Thank you, Mike, for having me. And yes, actually, believe it or not, I use my psychology degree on a daily basis. The markets are all about psychology.
Yes, they are. They so much are. We met you last year at our Cambridge portfolio management conference as a team, and we were so impressed with you, and we had many, many conversations. So I'm really grateful for you being on our podcast today. And again, I'm going to keep this really simple today, and I just want to start with a big picture for 2026 on your outlook of things. Everybody has a forecast. Every economist has a forecast, but just tell us what you guys are seeing there and what you think.
Absolutely, Mike. So in our view, 2026 is basically shaping up to be a year of moderation for the U.S. economy. Growth is expected to continue, but at a more measured pace. Most people are forecasting U.S. GDP growth to be around 2%. There's estimates ranging from 1.8 to 2.4%. And we're kind of right in the middle of that ballpark, right around 2%. The job market is going to probably pull a bit. Unemployment's going to tick up to the mid-4s range. It's not going to collapse, just a slowdown. We're not going to see a spike in unemployment. Job growth is going to continue, but basically at a gentler pace. Wages are going to basically remain strong, which is good news for the consumers, especially since consumers drive U.S. GDP growth. But you're going to see more sticky inflationary pressures within the economy, and policy uncertainty is going to basically keep things a bit interesting as it pertains to U.S. policy, but also geopolitical, et cetera. From an inflation standpoint, we're likely to see inflation be sticky near about 3%, and that's basically where we're going to start off the year, is kind of hovering around 3%, all driven by the lingering tariff effects and wage pressures. But we're expecting it to ease to about 2.5% by the end of the year, as you're going to see supply chains normalize and monetary policy loosen by the end of 2026. Market participants, just in general, are currently pricing in 2 to 3 Fed cuts over the next year. We think, in our view, that might be a bit aggressive, given the Fed's dual mandate of supporting full employment and controlling inflation. Chairman Powell's term's ending later this spring in May. So much of the coming year's policy is going to be dependent on his successor. For right now, though, it looks like we're going to be on hold for the remainder of Chair Powell's term, and we might get 1 to 2 rate cuts under the new Fed chair, with Warsh and Haskett being the two front runners right now. At the end of the day, no one knows who President Trump's going to nominate, but Warsh and Haskett are the leaders. And if that's truly the case, one of the two of them do get assigned the Fed chair, then we should be on a course to kind of normal Fed policy like we were under Powell.
Yeah, and obviously too, being a political year and midterm elections, that's probably going to affect a lot to these rate cuts too, from that aspect. Any on AI that as it reflects back to the labor market or in general to GDP? Just curious on that, because different podcasts are saying different things this year, or different economists.
Yeah, so it's actually interesting because obviously AI has been that big structural story over the past, we'll call it 2 to 3 years. You started to see technology, I'll call it, take an arc in 23 and 24 with that hyperscaling occurring last year. And You're starting to have companies talk more and more about the efficiencies that they're gaining, et cetera, due to their AI CapEx spend. But believe it or not, there's been a couple of studies, Mike, and I think you and I had talked about this last time we spoke. But there's been a couple of studies. One was done by Bane and another was done by MIT. The Bane study itself had actually suggested that companies are going to spend somewhere around $2 trillion of a combined revenue by 2030 to fund computing power that's needed to meet the demand. But the likely revenue will fall short by about 800 billion. And then in addition to that, the MIT study found that even though there's been so much AI CapEx spend, just 5% of integrated AI pilots have extracted any real dollar values to the bottom lines of companies. And that's just because a lot of these companies are large organizations that have, I'll call it, a lot of brittle workflows and a lot of misalignment within their day-to-day operations. So adding AI to the mix is just going to break down a lot of their flows, because if you think about it, a lot of these companies grew and grew and grew by acquisitions. So you had to do all these random plugins to be able to have those companies harmonize their systems, we'll call it.
Right. Yeah. Tech stacks work together. Yeah, absolutely.
Tech stacks, exactly. And so at the end of the day, when you're thinking about that, being able to implement AI, and yes, you'll eventually get job savings over the next, and it's going to be lower wage kind of work, we'll call it, over the next maybe decade. But right now, it's a lot of CapEx spend with a lot of the profits not probably going to be seen, and a lot of those jobs savings per se for an additional 5 to 10 years.
Okay, I want to double click into one thing you just said, and that is you said 800 billion shortfall in revenue from the not. So in other words, so that's the actual. They will not see the output from what they're spending in simple layman's terms, correct?
Correct.
Wow, that's a huge number, and you see people talking about that on there. I think the biggest thing that I took away from this was the shortfall in revenue of AI investment. I think that is huge. That just and everybody's spending because what do you think they're spending because of FOMO? Is that what they're spending from?
They are. So they're spending because they don't want to be left behind.
Right.
But at the end of the day, you're basically doing all this CapEx. So what we didn't get into is you're going to have a delineation this year where it's not all tides. So the tide doesn't rise all boats. Where up until now, anything that had AI or AI attached to it, there was a huge run up in the stock prices. And I think the other interesting part, to piggyback off of your comments, Mike, when we're talking to a lot of the IT consulting firms within our universe, it's actually interesting because they're doing a lot of the IT consulting to a lot of these Fortune 500 companies, et cetera, to figure out how to integrate AI. But a lot of the CapEx spend, a lot of the leaders at these firms have already earmarked the CapEx spend. But what they're worried about is you had the iteration of AI so rapidly growing that they don't want to actually implement something and then in 6 months from now, it become useless and have to redo another iteration of integrating new AI within their system. So what they're doing is letting that iteration kind of flow through a little bit until you kind of get who the winners and the losers are going to be. And then from there, they'll actually utilize that AI CapEx spend to start implementing in a more fruitful way. Yeah,
it's funny because I can, again, small business world, that's where we're at. But I have some really, really smart young advisors, and they always want me to try the new greatest thing, and I have to tell them no. So because and this is proof of concept. You could get too much, and then your cash flow is none of that flows. So you just got to get good at what you got, and then see where you're at and make small iterations here and there. So, which is going to segue to my last subject to you. And being here in Nebraska, one of the biggest things that's near and dear, and especially to a lot of small businesses, which are the backbone of our country right now, regulation cuts. And you talk about the Trump administration and them talking about that. So what regulations do you think are coming next year that we could see or deregulation or regulation cuts to help small businesses in 2026?
Absolutely. So I think first and foremost are the corporate tax cuts. I know President Trump campaigned on lowering the corporate tax rate from the 21% to anywhere as low as 12%. I will say to you, if I had to bet and be a betting person, which I don't like to bet, but at the end of the day, if I had to, I'd go back and fall back on where he negotiated the TCJA, so the Tax Cuts and Jobs Act 15% threshold that he was trying to achieve in his first term, where it was negotiated down to up to 21% from the 15% that he wanted. My gut tells me he's going to want to negotiate it back down to the 15%, which is what he originally wanted to. So that obviously is going to help small businesses, and every dollar matters to their bottom line more and more from that perspective. You're also going to have the 100% bonus depreciation for certain capital investments and the immediate expensing of $2.5 million in qualified property and equipment purchases, and also the R&D spend. You'll be able to write that off. So I think from that perspective, that's also going to help small businesses. So at the end of the day, there's a lot of red tape that's also going to be cut. So the deregulation, because if you think about it, a lot of the small businesses, to be able to deal with a lot of this red tape, they have to spend a lot more money of their revenues versus the large companies that make that much more revenue. So every regulation that kind of gets cut in half, we'll call it, or I think President Trump is basically saying for every one new regulation, he wants to cut 5, right? At that point, if that happens, and that truly does happen, that'll mean less revenue spend to deal with a lot of administrative costs for a lot of the smaller companies, which will help their bottom lines.
Absolutely. And we certainly hope to see the regulation cuts. That would be an added win to our sales here for small businesses, which again are the backbone of our country. The only other thing I've seen out there that could the upside surprise of some of that tax stuff, but listen, I mean, the biggest thing that I keep thinking of, and it was said this morning on CNBC, was what does happen if Trump's tariffs get basically struck down by the Supreme Court, which we should be hearing that in probably January or
beginning
early
of the year
February.
at some point.
Yeah. What do you think?
So what happens is that there's other avenues that President Trump can actually take. So they're called IEPA, and so what that stands for is International Emergency Economic Powers Act. So if the IEPA, and everyone calls them IEPA tariffs, so if they get struck down, I think first and foremost, what no one's talking about is that it's going to result in about $100 billion in refunds from the tariffs perspective. And so companies are already lining up to get some of those tariffs back, which means revenues have to come out of the U.S. economy to actually fund those. So that's number one surprise from a tariff perspective on the IEPA kind of being deemed illegal by the Supreme Court. Now, at the end of the day, that doesn't mean that if that does happen, President Trump has other avenues to be able to reestablish a lot of those tariffs. So at the end of the day, by the end of the year, you'll still have a similar tariff rate. There's just going to be other avenues he's going to take. So there's Section 301 of the Trade Act of 1974, and that actually allows the president to impose tariffs on other trade measures in response to unfair trade practices. This is typically used in trade disputes, particularly when countries are accused of discriminatory practices. So he's probably going to lean on Section 301 of the Trade Act of 1974 first. And then second, his other option is Section 232 of the Trade Expansion Act of 1962. And that actually grants him authority to impose tariffs for national security reasons. And that was the whole basis for the steel and aluminum tariffs. So those two are going to be the first ones that he's going to lean into to kind of reestablish a lot of the tariffs that he's already put in place with a lot of the countries. And then in addition to that, if he still needs to implement additional tariffs, you can get obviously congressional action. So you can go to Congress and have Congress pass new legislation granting him tariff powers or creating kind of new targeted trade remedies. And then you can go to the WTO as well as domestic trade laws that basically talk about anti-dumping and countervailing duty laws and on tariffs, et cetera. So those are some of the other avenues that he can take. So at the end of the day, the effective tariff rate of 20%, which is what President Trump is looking to get at to kind of counterbalance, obviously, the spending and the tax cuts that he's put into place, he'll still be able to get them, even though the IEPA tariffs might be deemed illegal.
Yeah, you know what's interesting is Scott Bessent was just on my favorite podcast, the All In podcast. They did an interview with him, and he talked about a lot of the things you're saying today. And the interesting point I took from that too was Scott Bessent talked about, everybody should have on their bucket list to go to a Supreme Court hearing, and how smart all these justices are. And they're very, very intelligent, and their lines of questions are amazing. And some of the points you just made there, he referenced in there, and specifically Judge Amy Coney Barrett said, hey, this could create some serious chaos if we were to take that back. So hopefully, if anything, if they did strike it down, would be not making the government pay that back, because we know we have a significant deficit in this country, and the bond vigilantes could show up if we have to pay that back. Would you agree with that statement?
Absolutely. And that could actually cause a risk-off market environment and cause the markets to sell off and cause dislocation for short-term purposes.
Absolutely. Yeah, that's just such a huge point. I think we need to really watch that, because whether you like tariffs or not, there's, to some degree, they have really worked this year. And it's been and what Scott Bessent says is, he says it's a way to get the trade imbalance back in order. And very intelligent man. He's been a really good addition to as a Secretary of Treasury, not to make a political statement, but he's done a nice job.
Yeah. And I will say that's my biggest, I will call it, risk for the year, is the tariff renegotiations. Yes. That everyone has been put to sleep and caused less geopolitical uncertainty, rear their ugly heads, which is going to happen. And that causes a lot of uncertainty in the markets and a lot more volatility throughout the year for 2026.
Okay, I always like to close on this question. What is one of your favorite podcasts that you are listening to now, or you listen to regularly?
So one of my favorite podcasts is Capital Economics. They are a firm out of the UK, but they actually do global economics. And the team over there has been phenomenal on not only giving base cases of what could happen in the economy, but also scenarios on worst as well as best cases, and also provide you the backup for that, so you can actually interpret the data and be able to then come up with your own analysis on what's going to occur. So I think being able to see the lens through all different scenarios to come up with your own conclusion is helpful, because a lot of times, a lot of the news that we get fed is through a lens of one particular publication or one particular news story, etc. I think being able to get that full lens gives you a better picture to kind of analyze the economy.
Absolutely. Yeah. More information, more data, the better. So Maria, thank you for being a guest in the podcast. Thank you for being a good partner to our firm. I know we've been able to call you a couple different times and ask questions with our different client portfolios. And again, you run the Boston Small Mid Cap portfolio with Aristotle, and you're definitely one of our strategic partners here. So thank you again for being a guest today.
Thank you, Mike, for having me, and thank you to the listeners for listening to the podcast.
Thank you, Maria.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Inc., a registered broker-dealer, member FINRA. Fixed insurance is offered through various independent insurance companies. Cambridge does not offer tax or legal advice.